market right here, Nidhi, now fairly tempered, trying to push it through that 11,600 mark. At least the Nifty futures are back at that level. ONGC is putting on some weight. You've got BPCL, you've got IOC, Titan, Bajaj Finance. These are some names which are holding the Nifty up. Though on the other side, it's a tug of war with the Tata Motors, that's down, Vedanta, Maruti, Hero MotoCorp, Tata Steel. Metals and autos largely are pegging the index back. But let's welcome on board Rajiv Sabharwal, the MD and CEO at Tata Capital. Rajiv, hi, good morning. First of all, congratulations for completing the first year in office. Tell us how it's been, and also by now you may have formulated the strategy for the next 5 years. Tell us a little bit about it.
First year has been really exciting. Let me say there have been huge opportunities. The fact that we carry the name of Tata's just gives us an option to be in a space in which we can really leverage our group benefits. We are a company which is about 60% retail, 25% SME and 15% corporate stroke infrastructure. It's a diversified set of assets. We are pretty granular on our book. We don't take bulky exposures, and that is what has helped us in creating a book which is of good quality. This year actually saw a fair amount of turmoil post the ILFS crisis in terms of monies for some companies becoming slightly tight or cost of money going up. But we never faced a problem on liquidity. We could access money as and when we wanted. We're thankful to all banks, mutual funds and all other entities who've been supportive of this. The only thing which we saw was the cost of funds moving up during that period. But we've seen that post-February, once RBI did intervene to keep the cost of money in check, the cost of funds has been coming down, and that continues to do.
Okay, fair point. NBFCs, Rajiv, have had a turbulent last few months. Has the era then of hyper growth coming to an end for this particular sector, or would you not really reject it outright?
I think for any entity, the growth rate should be moderately high and not hyper growth, because it's very difficult to control the quality of the book if you grow very, very fast. I feel what will happen is this, which we've seen playing out in the recent past also, is that money is trying to chase those entities which have a very strong parentage, companies which are good on quality of book, and which have a strong net worth. So a good capital base, a strong parentage and a good business strategy is where money is trying to move towards, and that will continue to happen. I feel in the past we were seeing mushrooming of companies happening both on the NBFC and the HFC side. I think so that will moderate a little bit, and any entity which is let me say not right on the product mix may see a consolidation of that with some other entities.
Mr. Sabharwal, we did see borrowing costs for the sector edge higher. Have they stabilized right now? And also, is there the ability to pass on that extra cost to the customers as demand in high select segments is also flagging? Actually,
speaking, NBFCs have both type of assets, fixed rate assets as well as assets where rates are linked to a benchmark and the rates may move up or down. So whenever there is an increase in cost of funds, you will see some amount of compression in the NIMs of entities unless and until most of the assets are variable rate assets. I feel the ability to pass on these rates does exist, but as I said, it's going to be a combination of fixed rate versus floating rate products. So if you're biased towards a fixed rate product, then your ability to pass on the existing book is that much more difficult.
Right. And what's the sense that you're gathering, working with some of the retail borrowers? Give us a sense as to the on-ground situation of the softness in demand.
I feel if you look at the growth rates, they vary depending on the product per se. For example, the auto industry has seen some muted growth during the year. The same may not be true for commercial vehicle and construction equipment, because both have had good years in terms of growth. If you look at personal loans, credit cards, some of these asset classes have seen very good growth during the year. Housing again has been a mix, because premium housing has not seen a good growth, but affordable housing, courtesy the support which the government gave to this sector, has seen growth rates of double digits. So I would say growth rates across the industry as far as retail is concerned, except for the auto sector, have been reasonably good, and still there is an opportunity to grow. I think what is also happening is that a lot of NBFCs are moving to tier 2, tier 3 markets also. One, because competition is slightly lesser there, and two, also because some of these markets are less penetrated on credit, and this gives an opportunity for the lender to acquire a better market share there.
Over 60% of your book is retail currently. How's demand in the various segments, and what strategy are you looking at?
So our strategy is, a function of what, our group chairman has also spoken about. It's about scale, synergy and simplification. All these things are three things we have embedded in our strategy for the future. When I talk about scale, we want to grow. We want to grow at a rate which is better than the market growth rate. We want to be fairly diversified in our set of asset classes, so that no one asset can ever cause us pain if it goes through a problem. It also allows us not to have any bulky assets on our book. When we talk about scale, we are also looking at how we can increase our margins on products, how we can expand our ROEs. All of them, are a part of our thought process on scale. The other thing which we are looking at is, since we are part of a large group, and we enjoy the benefit of that, we are looking at how we can work more closely with our group companies to increase our business, whether it is working with them to finance them or their customers or the employees of Tata Group companies. So we're working on each of these aspects to ensure that we create more synergy and move more towards the one Tata philosophy which we have. The third thing, which is extremely important to us, since, we believe that technology and digital is playing a much bigger role in today's, NBFC environment, whether it is in terms of growth, whether it's in terms of risk management, or it is in terms of how we use analytics. We are probably, this is an area which is consuming the maximum amount of investments as far as Tata Capital is concerned.
Okay, so as we discussed, there are some stressed assets available in the sector. Have you been offered some of them, looking at the organic route perhaps as part of your strategy?
I think so. There is a fair amount of things which have been offered, but at the moment we are focusing on our organic strategy. We believe that there is, because of the reasons which I mentioned to you, there is enough potential for us to grow. We are not short on capital. Our parent has given us capital whenever we have required. Similarly, when we are trying to raise money through debt, whether it is ECBs, whether it's public debentures, whether it's private debentures, CPs, we are now looking at also doing a dollar bond issuances. So in each of these things, we are realizing that in terms of liabilities, we are not short on that. And if we can grow our book organically, we will have far better control on the quality of book. One of the things which is very important in this business is to ensure that you manage your risks well. This is a business of long term. This is not a short term business in which we are in. And for that, the quality of our book should be pristine. And I believe that, it is very well possible if you grow your book organically. And that is what we are focusing on. So currently in our radar, it's all organic.
Right. You've also guided at a 25 to 30% growth. Do you see that being possible without buyouts? Because some of the peers have scaling down growth.
No, I think if we look at the year which went by, we've seen that growth happening both on the top line and the bottom line. We believe that it's possible for us to look at a similar growth for the next foreseeable future. There is tremendous opportunity in each of the sectors in which we are present in, whether it's SME or whether it is retail, whether it is housing, affordable housing. So in each of these sectors, there is growth which is possible, and growing at rates of over 25%, we don't foresee that to be a challenge for the foreseeable future.
All right, appreciate you taking the time out and joining us exclusively on ET Now, giving us a flavor as to how things stand for your retail book, the overall outlook for the sector, as well as, the kind of strategy that you've outlined over the next 5 years.